everybody, and today we will talk about trading gold. Market participants often fail to take full advantage of gold price fluctuation because they haven't learned the unique characteristic of world gold markets or hiding pitfalls that can rob profits. Whether it's behaving like a bull or bear, the gold market offers high liquidity and excellent opportunities to profit in nearly all environments due to its unique position within the world's economic and political systems. As one of the oldest currencies on the planet, gold has embedded itself deeply into the psyche of the financial world. Nearly everyone has an option about the yellow metal, but gold itself reacts only on a limited number of price catalysts. Each of these forces splits down the middle in the polarity that impacts sentiment, volume, and trend intensity, inflation and deflation, greed and fear, supply and demand. Gold attracts numerous crowds with a diverse and often opposing interest. Gold bugs stand at the top of the heap, collecting cycle bullion and allocating an outsized portion of family asset to gold equities, options, and futures. These long-term players rarely dissuaded by downtrends, who eventually shake out less ideological players. Take time to learn the gold chart inside and out, starting with a long-term history that goes back at least 100 years, in addition to carving out trends that persist for decades. The metal has also tricked lower for incredibly long periods, denying profits to gold bugs. Gold's recent history shows little movement until 1970s, then following the removal of the gold standard for the dollar, it took off in a long uptrend, underpinned by rising inflation due to the skyrocketing crude oil prices after topping out at $2.076 at once in February 1980. It turned lower near 700 in the mid-1980s in reaction to restrictive Federal Reserve monetary policy. So the fundamental and psychological factors that move gold prices are largely unknown or overlooked. With that being said, let's have a look at the most common factors that influence uh, cycle gold prices. Perhaps the biggest influence on the gold prices is monetary policy, which is controlled by Federal Reserve. Interest rates have a big influence on the gold prices because of a factor known as opportunity cost. Opportunity cost is the idea of giving up a near guaranteed gain in one investment for the potential of the greater gain in other. With interest rates holding near the historic lows, bonds and CDs are in some cases yielding nominal results that are less than national inflation rates. This leads to nominal gains but real money losses. In this instance, gold becomes an active investment opportunity despite its 0% yield because the opportunity cost of foregoing interest-based assets is low. The same can be said of rising interest rates, with the boost interest-bearing asset yield and push opportunity cost higher. In other words, investor would be more likely forego gold as lending rates rise and they be netting a high guaranteed return. Federal Reserve commentary can also move the gold market. The Federal Open Market Committee, which holds meetings about once every 6 weeks, discuss the state of the US economy and the figure of the monetary policy. Another driver of gold prices is US economic data. Economic data such as job reports, wage data, manufacturing data, and border-based data such as GDP growth influence the Federal Reserve's monetary policy decision, which can in turn affect gold prices. Growth is not set in stone. A strong US economy, low unemployment, jobs growth, manufacturing expansion, and gross domestic product growth in excess of 2% has a tendency to push gold prices lower. Strong economic growth implied the Fed could make a move to tighten monetary policy, thus impacting the opportunity cost dynamic discussed above. It might be oft overlooked point, but simple supply and demand economics can influence physical gold prices as well. As with any good or service, increased demand with a constrained or a low supply has a tendency to pull prices of that good or service higher. Conversely, an oversupply of a good or service, uh, which stagnant or weak demand can push prices lower. A further factor that can impact gold prices is inflation, or the rising price of goods and services. While far from guarantee rising or higher levels of inflation tends to push gold prices higher, whereas lower levels of inflation or deflation weigh on gold. Inflation is almost always a sign of economic growth and expansion. When the economy is growing and expanding, it's common for Federal Reserve to expand the money supply. Expanding the money supply dilutes the value of each existing monetary node in circulation, making it more expensive and buy assets that are preserved store of value such as gold. This is why quantitative easing programs that saw the monetary supply expand rapidly were viewed as much as positive for physical gold prices. The movement of currencies varies significantly. The US dollars and the price of gold is dollar denominated is another strong influencer. A falling US dollar has tendency to push gold prices higher because other currencies and commodities around the world increase in value when the dollar falls. On the contrary, dollar often comes about because of a growing US economy. Among these seven factors, the action of electronic traded funds or ETF are more than likely the smallest influencer of gold prices. ETFs aren't designed to be market movers, but they're still worth mentioning. ETFs are basket funds investors can purchase that allow for increased liquidity and the potential ability to spread their risk over the large number of assets for a minimal cost. The largest gold ETFs is the SPDR Gold Shares ETF. Purchases or sell physical bullion based on demand from investors. As investment demand for gold changes, the price can be affected by the purchasing and selling activity of ETFs. There is no one specific factor that can be listed here that perfectly encompasses the uncertainty that can move gold, but political uncertainty and instability is probably the best example. But plainly, the stock market caused Certainly, and it's often the enemy of gold prices. Not knowing how Brexit will turn out for the UK and Europe, who will become the 45th president in the USA, and whether terrorist treasure the Middle East can be dealt with are all factors that can contribute to global growth uncertainty and aid in raising gold prices. The one thing investors have to keep in mind is that uncertainty isn't a quantifiable statistic like many of these other points. It's completely psychological factor that investor depends and it can differ from one event to the next. Trade the gold market profitably in four steps. First, learn how three polarities impact the majority of gold buying and selling decisions. Second, familiarize yourself with the diverse crowds that focus on gold trading, hedging, and ownership. Third, take time to analyze the long and short-term gold charts with an eye on key price levels that may come into play. And finally, choose your venue for risk taking, focused on high liquidity and easy trade executions. For today, that is all. Thank you so much for your attention. Wish you perfect trades and see you soon.